Welcome to what will surely be a long and successful series of discussions on the rise of Sustainable Concrete Group. Something a little bit different for me today, Tony, is I'm on the host side of the questions. I'm very familiar with the podcasting scene, but I haven't been the host before, so our audience will have to bear with me. But today I'm joined by Tony Schiavello of BDO Australia. Tony, you bring more than 20 years of experience in the M&A space. You're the national leader of mergers and acquisitions for BDO, and it's a pleasure to have you here with me.
Thanks, Oscar. Great to be with you. Yes, that's right. I've been at BDO now for just on 8 years, but prior to that, I started my M&A career in Australia at KPMG back in 2001, and was there for about 14 years, and then growing the business at BDO thereafter. And so it's great to be with you and looking forward to continuing to work with you and the broader team with Sustainable Concrete Group.
Fantastic. Let's dive into it. Where did you start? How have you progressed? And what have you enjoyed most?
Sure. So I started as a chartered accountant at Pitcher Partners.
Wow.
Way back in '94. And so I did 4 years there and qualified as a chartered accountant, and then moved to London to get into investment banking over there. And that was an exciting time, much larger market over there, as you can appreciate.
And a great life experience, I guess.
Oh, indeed.
Internationally.
Yeah, indeed. So I got to do a lot of travel and so forth. But they look exciting times, and I look back on them fondly. I can't believe it's almost 25 years ago since I got back from London. And so really, really good. And after that, joined KPMG, where I did 14 years in their mergers and acquisitions area.
Fantastic.
Yeah, and now I find myself at BDO heading up the M&A function there.
And I can't imagine how many deals you've been involved in. I guess probably from the earlier days, not so much leading, but right up until now, of course, you're the lead man on a lot of deals. Mm-hmm. Are there any memorable deals that have stuck with you over that career?
Yeah, look, I think the most memorable deal that I've done is probably the sale of Valrada to NRI Group. And that was a client that I'd known and nurtured over a good 5 to 6 years. A few false starts in terms of getting to the outcome there as the business grew. Then COVID came, and so it was a great example of a business that had humble beginnings but really became a large leader in its space. And to get a successful result for the team there was really rewarding, not only for them but for us as a team.
Amazing
as well.
Amazing. And favourite deals is probably a good segue here to introduce Sustainable Concrete Group and what we're doing, recycling waste glass into a like-for-like sand replacement that can be used in construction, predominantly in concrete is our focus. Mm-hmm. We've also introduced an M&A division of the business, which is now proudly represented by BDO. The segue for us into M&A was noticing opportunities where we would agree to supply $200,000 worth of our sand to help a contractor win a $60 million tender. And we thought there is a massive commercial upside to the use of our product, which is an amazing driver for a business to have trading business success. But we saw it as an opportunity to be involved in, I guess, the application of this product as well, drive market adoption through being involved with the businesses, but of course, benefit from the commercial upside that our product was providing to these businesses. So we've since been exploring and now have control of 7 businesses under contract now in the civil construction space that, of course, you are very familiar with. Tell me, what do you see for the SCG model? What do you like about it? Do you want to explain a little bit more about our model in more M&A terms than I can describe?
Sure. So what I like about it is it's a diversified group with strong linkages into the building and construction sector, which continues to be the need for infrastructure in Australia is continuing on a strong basis and will do so for the foreseeable future. I think a lot of that investment's led by government and larger organisations who have absolutely bought into the sustainable or green element, environmental impacts and so forth. And so nearly on most opportunities that we see that governments and government departments go out to tender on larger projects, there is a need or a desire at the very minimum for a green concrete and green or sustainable building product input. And so that shows to me that there's certainly a market for that that product. And you can look at the larger players, whether they're Adbri, Boral, or Holcim. They've all got their own green concrete offering. But at that smaller end of the market, the ability to invest in the technology to make that happen is an opportunity, and one that you've highlighted as a management team, and I think quite an exciting one. In terms of the 7 acquisitions, great national diversity and coverage, and right across the building spectrum, not only in concrete, in full-on construction, but ancillary services as well, and into roads. And so from that perspective, that green element really permeates, and I think helps really set a differentiation to other offerings that are out there. Mm-hmm. And so there's some exciting prospects that we as an organisation are working with you and your team on undertaking that due diligence to make sure that there's financial robustness and in systems, processes and financial results. And we'll continue to do our work, but all indications so far is it's going well.
Fantastic, fantastic. There's 2 approaches that I see under the Sustainable Concrete Group M&A model, for lack of a better description. And one is there are a lot of older gentlemen that have been in the space for a long time, worked very hard, and it's proved quite difficult in the market to build a business within the industries that we're talking about that is a sellable business. And I think just with the trends in human behaviour over the last decade or so, these guys, they don't have a lot of succession planning, whereas more traditionally, decades ago, it was common for the construction business to be passed down through family. Mm-hmm. Now, the conversations that I'm having is that the eldest son, daughter, whoever it may be, may not have interest in rolling up their sleeves and being involved in a less trendy or a less sexy industry. So these older guys, they don't have succession planning, and that's providing a lot of opportunity for businesses like SCG to take on businesses that have incredible track record, incredible relationships with both supplier and customer side, and are allowing us to purchase, almost turnkey businesses that can benefit from some of our expertise, some of our consultants and advisors' expertise, and then just a little bit more, institutional framework around what has historically been a family business. So it's one approach. The other approach is we're purchasing 50% of businesses, existing businesses, and these are generally younger, slightly younger operators. They might be late 30s, early 40s, and they're not ready to hang up the gloves. Mm-hmm. They've worked very hard for 10, 15 years, but they haven't got a whole lot more than paying a lot of tax and maybe paying off their family home. They haven't really reaped the benefits of their hard work and success. So we're coming in, providing an opportunity to take some of the chips off the table. We write them a check for half of their business, and then we provide the institutional framework to help grow the business with them. We, of course, supply our sand, which helps them win Tier 1 and government tenders. As you mentioned, a lot of these government tenders now are almost mandated, or some are mandated to have the most available green resources, including in concrete. And then the real, arbitrage opportunity or the upside opportunity for these operators is they will sell 50% of their business to us now, and they'll sell that on a multiple that reflects the commercial framework of their business and the wider market. But then they get to come on the journey to really reap the reward of the future of SCG. And what that might look like is they're selling now based on a business that may be doing $30, $40, $50 million revenue with a decent EBITDA. Mm-hmm. But as part of a group down the track, as they bolt in to our group of businesses, there will be opportunities surely that arise, whether that's a future trade sale event, a listing event, or an internal buyout from us within the group, where their business trades on a multiple that reflects a much rather group than their individual business. And that's really the upside that is attracting these operators. If 2 to 3 times EBITDA multiple is standard for their business side currently, but they're part of a group that's 500 mil rev with a substantial EBITDA, then there's opportunity to divest further in the future at a much higher multiple. Mm-hmm. Is that your view of the market, or am I sugarcoating it too much?
No, look, I think there's lots of evidence across many industries about what you've described as a roll-up play in highly fragmented industries such as building products, and even when you get deeper into concrete. yes, you have some large players, as I've mentioned those names before, but there's a plethora of smaller businesses that, as you say, Oscar, they're family-owned businesses. And so they have been built from scratch, from the ground up. And typically, and this is a generalisation, those that don't get beyond a certain level never get beyond it because there's a step change required from additional working capital, then greater infrastructure, back office functions and those sorts of things. And that can impact profitability, but it also comes to a point where does that vendor, or the owner rather, want to invest further to scale up? And so you get those that do, and they become the larger players, and then those who they know what they know, and they know their own game, and they don't want to get too big. It's more of a lifestyle business, and so there's plenty of evidence out there that roll-ups have come to fruition and delivered great value. I think the uniqueness about the model here is that, yes, we've got 7 acquisitions that you've stated previously, and they form the platform of the group, and they will be wholly owned by the group. But importantly, with strong lock-in mechanisms for those vendors to continue to add value and transition over time, so that previously vendor relationships are company relationships. The benefit of a central office is really, really strong benefit, because you can get really great synergies. And so when you've got 7 businesses come together to create a business of scale with EBITDA approaching 30 million and beyond, that gives you great capacity to invest in systems, processes, and leverage great synergy. You don't need 7 different accounting functions. You can have one accounting function that looks after the group, but can scale to then look after that second wave of acquisitions that we're currently looking at as well.
And really help, I guess, absorb the increased costs that you mentioned that often stop these businesses going to the next level and really becoming of larger scale, because on their own it becomes a mean feat. With those costs spread, of course, it becomes a little bit more palatable on the bottom line. And then with the support of a wider group and experts that may not be as readily available to the mum and dad business that's trading as a single operator.
Oh, that's right. And I was just going to mention the ability to attract talent, so corporate talent, managerial talent in a larger organisation with defined career pathways, much higher than family-owned businesses who, understandably, they cap out in terms of the people that they can bring in and the salaries that they can pay. So quite an exciting opportunity, and one which you can see the model how we can leverage through growth and start to deliver on our on the goals.
Absolutely, absolutely. Before we delve into deal flow, of which we've built a proving successful model of consistent deal flow, tell me what makes for a good deal. Is there an emotional element to it? I understand a lot of it's numbers. Is it all numbers? Is there an intuition piece of 25 years experience that you rely on? Or what are we looking for in a great deal in an acquisition?
Look, successful deals at their heart have a clear understanding about what is the sustainable competitive advantage that you're looking to build in the business that you're running, acquiring, consolidating, growing, right? And so the market continues to be quite competitive out there. There's new technologies always coming in. There's always competitors looking to take market share. Now, if you compete on price and price alone, it will be a race to the bottom. And so my experience has seen those more successful companies have a really clear vision about what it is, what is the market they're looking to enter, how will they service it in a way that provides sustainable competitive advantage, and whether that means they're ahead of the technological curve and becoming thought leaders, trailblazers if you like, or is it an underserviced part of the market that the larger players don't want to participate because those clients are too small to serve profitably, but nevertheless provide a great niche for consolidators to grow into and really own that segment of the market. So if I replay that back, a view of sustainable competitive advantage is a key thread running through that.
Which sounds a little bit like innovation would play a large role of that. And then,
Yes.
as you mentioned, market opportunities present and advantages can arise just by understanding and identifying those market opportunities before anybody else is servicing that market. The inverse of that, I guess, what are some red flags, or people in the industry understand that not every M&A acquisition either is great from the outset or looks great from the outset but doesn't prove to be a great acquisition. What are some of the red flags when we're looking at deals that we need to be mindful of?
Some of the red flags are culture. And so you can have the best business plan and idea in the world, but if you've got a management team or a broader corporate culture that is not cohesive, and there's friction, that can really destroy value very quickly. And we've seen that in a number of instances where deals have fallen over because there's just a cultural misalignment. And now that, whether that's an absolute pursuit of dollars at the expense of well-being of staff.
When you say misalignment, do you mean among the team or among the business team or among the team and
Both.
representatives?
Yeah,
Okay.
both. So it can be misalignment amongst the team
Yeah.
and who empire building and defence, but also misalignment from a culture, from a buyer's perspective, investigating the potential acquisition and saying, this is toxic for us.
Not the right fit.
Not the right fit, and walk away. And I think, nevertheless, the financial benefits of those deals we've seen, in my experience, are there, but the sugar hit is soon lost if you let that bad culture permeate through your own larger organisation. And so
After the honeymoon phase, we really need to ensure that culturally everybody who not only within the business but represents the business is aligned to what the strategy is moving forward, how the business operates moving forward, and how the people within it, I guess, act moving forward.
Yeah, look, I think that's right, getting alignment. So the due diligence process absolutely looks at that culture and sees how it fits. Is there an alignment of aspirations in the business plan? And if they all go well, that robust work, then that sets up the organisation for success. But having misalignment in that process provides a red flag that should be dealt with or walk away.
Yeah. All right. A little bit more on SCG strategy. Something that really excites me is I don't have a deep understanding of M&A. I'm learning more and more every day, but my understanding has been that within every industry, it gets on the radar of these institutional buyers often that come into an industry and they buy up a lot of mum and dad businesses, and they are very successful, and it proves very lucrative to roll them up, like you mentioned, in a roll-up strategy, and then whether that's trade sale them or list them, and it really proves enormously valuable to them. What I like about SCG's ongoing strategy is that we're sharing that upside. It feels, I'm commercially motivated, but it feels somewhat noble to bring the founders on the journey rather than sell to another PE player who's going to take out 100% of your business, roll it up into their group, and then make tens of millions of dollars off the back of it. Come on the journey with us, take some chips off the table. You know, nothing's risk-free, so take some cash, pay off your home, you know, invest some money elsewhere, take your wife to Europe, whatever it may be, but then come on the journey and share in that upside that is genuinely reserved for PE players only. There's not a lot of platforms out there that are bringing the founders on that journey and providing them access to the potentially incredibly lucrative commercial outcomes of a roll-up play. Are you aware of anybody else in the market that is bringing founders on this journey, or is it more of it's reserved for the bigger players?
Yeah, it's over the last 5 to 7 years in particular. So before that, private equity was a strong source of capital for roll-up plays, either led by the private equity fund or one of the larger participants in a market who then pitched the story about a fragmented market and get access to capital to grow. That role is increasingly being filled now by family offices. And so a number of family offices are out there funding these sorts of plays of roll-up consolidation. in a range of sectors, whether that's insurance broking or financial planning and those sorts of things. There's a lot of evidence of that being a successful strategy in the past. I think as it relates to, you mentioned coming on the journey. Look, I think that's important, not only from, and it goes to that cultural thing, not only from the vendor's perspective, but certainly from Sustainable Concrete Group's perspective. These are not takeovers. These are broader partnerships looking to create greater value in a partnership type model. And so these are not and should not be viewed as just pure takeovers. We'll take the keys and then move on.
Thank you very much. See you later. Yeah, it's not like that at all.
No, and certainly that's been very clear through discussions with yourself and Brendan. That's been a clear ethos that permeates through our team as we look to assist you in assessing the opportunities.
Fantastic. And our wider platform, we are building what we believe is a very repeatable, consistent and ongoing M&A strategy for Sustainable Concrete Group. Mm-hmm. That is largely fueled by the deal flow that we have access to. As you would know in the space, you have to kiss a few toes before you find the one. We are overwhelmed with deal flow, so much so that we've brought an internal team on to help filter through what we can tell from the early stages is an appropriate deal or not for SCG before we then pass it on to the experts at BDO to delve further and understand a little bit more about the business than we can see from the outset. Mm-hmm. That deal flow is largely fueled by the social media strategy that the team has in place and I guess the PR that the business has received from the broader tier one publications like AFR and the likes. How important is deal flow in building, I guess, a long-term impactful business in this space?
Look, it's deal flow can be opportunistic, but so it's important, but it's not the be-all and end-all.
Okay.
I think providing a platform of scale and ensuring that is then fit for further consolidation is vitally important. Mm-hmm. And so setting up those systems and processes such that you don't have indigestion in that in the next round of acquisitions is really important. And the amount of work that we see you and your team doing there provides comfort in that respect. Look, I expect that as we move towards transaction completion, the name will get out there, and that in itself will create further inquiry. And so, what I would say is that and speaking to Brendan, he has told me, whilst there's strong inbound inquiry from potential suitors, there's also a strategic overlay that the management team has put in place to sort of say, these are the areas that we're looking to grow into, and these are the sizes of the acquisitions that we're looking to go into. So you've got a filter there. I think that's important as well, and people need to understand that applying that filter in a disciplined way will help increase the success of making sure that the transactions that we pursue are the ones that are going to be winners for everybody.
All right, Tony, stepping back from the numbers a little bit for just a second, we had a little bit of chat off camera about what we get up to outside of work. The M&A space is notoriously demanding on a person's career. This isn't a passive 9-to-5 job. You've been in the space for a long time. What keeps you, I guess, focused, driven and stepping up to the bat in such a high demanding career? How do you find that? How do you juggle that?
How do I juggle that? Look, I love M&A from the perspective that it's high pace, high tempo, it's exciting. I get to see a lot of great businesses and not so great businesses, but what that experience has taught me is that you get to know what's the secret sauce, what are the qualities of our business that you think will be successful, and you can share that knowledge with clients as they look to progress their own journey. But as I mentioned previously, culture, financial discipline, and a clear strategy to to go towards sustainable competitive advantage are all important factors.
That's the secret sauce.
A lot of that is.
Yeah.
A lot of that is. So outside of work, to keep my sanity, I've got 3 beautiful children and a beautiful wife, and so every moment I can outside of the office, that keeps me really busy as well.
Fantastic, fantastic. And M&A, the future outlook, what are you noticing at the moment in terms of the broader market? How is the market? Where's capital going? Are there any trends that you're identifying that we should be aware of?
Yeah, so the market, if I recap on 2025, deal volumes were slightly up about 6% on the prior year.
For BDO specifically?
Oh, no, this
As
is
a general market?
as the
Okay.
Australian M&A market. From a BDO perspective, we had a similar year to the prior year in terms of deal volume. Deal sizes slightly up this year versus last, and this is the broader Australian M&A market. And that was fueled by some large announced acquisition activity, including the recent BlueScope transaction. So from that perspective, driving some larger numbers, and also Macquarie's proposed acquisition of Cube Group in transport and logistics.
Absolutely.
Yeah.
And where do you see the capital flowing at the moment? Is there a particular industry that's demanding attention? AI, of course, was a hot topic in 2025 and remains a pretty hot topic, but as you mentioned off camera, it's surely providing some volatility, and I expect there's some more to come. What do you see there?
Look, we've seen through January and into early February some significant volatility in the Nasdaq and the broader tech market. AI and its disruption on the SaaS model, software as a service model, has really come to the fore. And if you look at WiseTech Global, for instance, and the negative share price as that model comes under pressure or perceived pressure, I think that's a sign of the volatility that will continue to permeate through the market for the year ahead as AI stabilizes and people get to understand what is the new normal. But that provides opportunities in other markets that are more capital stable and a flight towards infrastructure. And so the intersection for me is a data center. AI data centers, significant infrastructure build and spend, but linked to the future of AI. And so that seems like a pretty positive intersection, which is no wonder driving a lot of demand for investments.
I would argue that Sustainable Concrete Group and our broader business model sort of fits somewhere within that intersection as well. Very proven industry in the civil and construction space that we're heavily involved in, but also a very innovative side to the business with the world's greenest concrete and what we continue to pursue there. Would you agree that we are well positioned to benefit from the stability of construction and the historic and continued growth of that space in Australia and abroad? But there are the potential moonshot upsides of the continual innovation in the recycled components and the desert sand component that we haven't much talked about before.
Look, I think, yes, as I said, sustainable competitive advantage is something that I've mentioned pretty often through this chat that we're having. And you're getting that through the sustainable element of green concrete. And so, yes, it is, I like the way you described it, that intersection between infrastructure and construction, which continues to move forward pretty positively in the Australian market, and the need for increased infrastructure as populations grow and urban sprawl continues is well documented. And so from that perspective, the opportunities from a market size and opportunity, I think you're well placed to capture your fair share of that.
Fantastic. All right, Tony, that's the end of my notes here. I don't have anything else on the M&A side, but a question that I'm frequently asked when I'm on the other side of these questions in the podcast that I've done before is, what is some advice that you would give to your younger self? A little bit off topic from M&A, perhaps not. You've been in the space. I know myself from what I've read, learnt and heard about you is that you have been very successful in your profession. What is some advice you would give to your younger self, as say a late teens, early 20s wanting to have a big impact in the professional world like you've had?
No, interesting question. Sometimes hard to answer on the spot. But
Absolutely,
look,
yeah.
Younger, look, I'd probably would have been more focused on private equity.
Okay.
I think certainly growing up in my professional career in the early 2000s, the private equity space in Australia was, compared to now, in its infancy. But when you look back over time, it's grown incredibly successfully from an underserviced market to now a well-serviced market. And so I think maybe more active focus on that. Some advice to someone starting their career now. Technology will be central to everything. And so having an appreciation of technology, I think is essential going forward. As our next generation comes through, they're digital natives, right?
Yep.
And so technology will always be central to them, but there are so many ways in which technology can spawn new opportunities in the way we're thinking. The jobs of the future. We call ourselves, and at BDO we have a mantra of advisors of the future, and what that means. I think the exciting thing is it's hard to define because there will be jobs in 5 years that don't exist now.
Absolutely, yeah.
So.
Yeah, fantastic answer, and I think we all wish we had that crystal ball in the top drawer often, but I think the next 5 years there's room for massive speculation, and there's a lot of unknowns too, right? We're right at the very start of I guess, a rapid increasing technology because of AI, and it'll be very interesting to see how that unfolds in this space and of course in all others.
Perfect.
All right, Tony, appreciate you having me. I'm sure we'll chat again soon publicly, and we'll talk a little bit more off camera about the deals that we've got currently reviewing for Sustainable Concrete Group. Thank you for your time.
Thank you, Oscar. Great to be with you.